home construction is still not where it needs to be, but mortgage applications to buy a newly built home jumped 20% annually in May, according to the Mortgage Bankers Association. Now, that coincided with falling mortgage rates throughout the month. Rates continued to fall into June and now are at the lowest levels in 2 years. So which builders are in the best positions? Well, John Burns Real Estate Consulting breaks it out. The public names look like this. KB Home's market conditions are best because they're concentrated in the Southwest, where the market's outperforming. NVR as well, because they build in the Northeast, which is bouncing back from weak demand a year ago. D.R. Horton's concentration in Texas and its focus on entry-level product also puts it in a good position for summer demand. Lennar's biggest footprint is in Texas as well, and Florida and the Southeast. Now, on the other hand, Tri Pointe and William Lyons Homes are slowing permits because about a third of their exposure is in Southern California, where demand is weak and costs are highest. But the problem for all home builders, though, continues to be high home prices. Half of the public builders have an average sale price above $400,000. Back to you guys.
Diana, stay with us. The mortgage market, as you know, is booming, declining rates pushing applications higher, which benefits buyers and lenders. The CEO of Quicken Loans telling CNBC that Quicken Loans has seen record loan volumes in the past few months. Since the Great Recession, companies like Quicken Loans have seen their share of the lending market grow. But many, including Jerome Powell and JP Morgan CEO Jamie Dimon, argue they need to be watched more carefully. Joining us now to discuss this is Chris Brummer, the professor at the Georgetown University Law Center. Chris, great to have you with us here. You see that this could potentially be a risk when the economy turns. Can you walk us through the steps as to why a non-bank mortgage loan could present problems?
Well, it's a little bit like, do you want to put Katie out on the basketball court against the Raptors, right?
No.
Right now, you have the opportunity where you have these loans. They've suffered different kinds of catastrophic injury back in 2008, but they have this shot of adrenaline called low interest rates, called a strong economy. Certainly low taxes probably have helped. But again, when the pressure is applied to those legs of these instruments, well, are they going to end up blowing out their Achilles? And that's really the question that's being asked, that when the economy starts to decelerate, are you going to have a challenge posed to these financial lenders, these non-bank lenders who are subject to fewer capital constraints? And are they going to ultimately be able to withstand that economic pressure?
So
and will taxpayers
I think to understand this issue, Chris, we have to focus in on the last part of what you said, and that has to do with the regulations. For non-bank to extend a mortgage, they're subject to fewer regulations or lighter regulation than, say, a JP Morgan or a Wells Fargo or any of the traditional banks. Is that what you're saying?
That's right. But ultimately, these banks are subject to fewer capital requirements, fewer liquidity requirements, and your traditional banks are also subject to much more rigorous stress testing, which can also ultimately impact the amount of capital that they have to hold.
Diana, you're shaking your head.
Yeah, I'm shaking my head because, look, you're talking about the capital requirements, and that may be true for the non-bank lenders. But remember, let's focus in on the loans. The loans they are making, the non-bank lenders, are largely backed by Fannie, Freddie, FHA. Therefore, they have to follow all of the guidelines as Fannie, Freddie, and FHA do for all the other banks. They are not any more risky loans. The vast majority of these loans are 30-year fixed, and they currently have the lowest delinquency rates than we've seen in years. So, yes, if there's a turn in the economy, that could hurt some borrowers, but it's not like these loans are any more risky than the loans that are being offered by the big banks or were offered. You know, I think everyone says this is the shadow banking system. There is nothing nefarious about a non-bank lender. They're simply not these depository institutions, but they're getting a lot of business, and they still act the way they do for Fannie Freddie guidelines.